Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Canadian ETF inflows hit $76 billion in 2024. That's a 45% increase from the previous record set back in 2021. A big trend was flows returning to bonds and duration. And while crypto was a huge driver of flows in the US, it wasn't actually so hot with Canadian investors here. What are some of the trends shaping the ETF space today and throughout this year? And how can your clients benefit from Fidelity's all-in-one ETFs? Joining us here to discuss this and more is Fidelity Director of ETFs and Alternatives Strategy, Etienne Joncas-Bouchard. Hello, Etienne. How are you?
Doing very well, Pamela. Thanks for having me on.
Delighted to have you here, joining us from Montreal. I think you just did something very similar en français, yes?
Yes. So we should be, like a well-oiled machine by now.
Perfect. Well, I kind of wanted to ask you a little bit about the performance story just right off the bat. We've got a few slides that we'll put up, but first of all, there are a number of different things that went into last year, and we'll take a look into this year as well. But if you want to kind of roll back the clock a bit, bonds were back, weren't they?
Yeah, I mean, definitely from a flow standpoint. Actually, if we could throw up slide one, we can kind of walk through some of the main themes from last year from an industry trends perspective. It was an outstanding year all around. You mentioned it in your intro, 76 billion in net new assets coming in. That's a sizable increase over the previous record year, which was 2021. We're talking about a 45% high watermark, if you will. So really something outstanding. And it came from all areas of the market with the exclusion of crypto. Once again, as you mentioned, equities led the way with about 40 plus billion in net inflows, bonds, 24 billion. And then it was kind of split up among other asset classes as well. Some of the main stories around that, you did see US equity mandates lead the way. Obviously, Canadian mandates and international equities also did quite well, but really the US was the main standout. And that's not, too much of a surprise when you're considering that the performance of US markets has been so strong over the past couple of years. On the fixed income side, great point you made with regards to bonds being back. I guess we could put it that way because what we had seen in 2022 and 2023 was sizable inflows into high interest savings ETFs, which were kind of that no duration cash alternative where advisors, investors, even institutions to a certain extent could buy a product that would give them, more attractive yields given rates were higher. But as we saw, the Bank of Canada definitely embark on a rate cutting cycle, and as well as you saw the US, start, but then maybe put a pause, you did see a bit of an appetite for just kind of more of the traditional fixed income assets. So bonds, government bonds, corporate bonds, those were more popular in 2024, definitely.
It's really interesting. I wonder if we can talk about a trend in here about how Canadians are exposed to the U.S. markets and therefore to the U.S. dollar, either through bonds or equities or a mix of all of them in the all-in-ones. I think Canadians think that we're pretty exposed. Where do Canadians think they're pretty exposed? Is it more to Canada or to the U.S.? I sort of feel like it goes back and forth. I think we're pretty exposed to Canada.
Yeah, I mean, it's hard to generalize for everyone. Everybody's portfolio is probably structured in a different way. But I mean, to take maybe a step back, I mean, like a domestic bias is real. I mean, Canadians buy lots of Canadian equities and Canadian assets. U.S. investors buy a lot of U.S. assets, and same thing can be said for other areas in the world. So for Canadians, though, I mean, having U.S. exposure last year was a net benefit, not only because U.S. markets outperformed, but our Canadian dollar also depreciated. So if you were holding U.S. equities that were unhedged, or you weren't covering, if you will, your currency exposure, that was a net benefit as well. So all in all, it's been a good thing to buy abroad for Canadians over the past couple of years. Not necessarily that's always been the case, right? It was great to be overweight Canada in periods like 2001 to 2008. So the dynamics will change as we go through various market cycles, business cycles. But for the most part, when we look at our all-in-one ETF portfolios, we're trying to take a full-on diversified approach. Like, we don't want to be exposed only to Canada or only to the US. We have, 50% of our equities in our all-in-one ETF portfolios are US, 25% Canada, 25% international developed markets. And it's not to say that, that's the optimal mix necessarily for every investor, but we feel like that's a fair representation of, yes, having a bit of a domestic bias, because if we put things in perspective, Canada's only 3% of global equity markets, so being 25% is significantly more. But we think that's a reasonable equity geographic mix for our portfolios anyways.
Yeah, it's fascinating. Actually, there's a great slide just taking us through some of the all-in-ones. Let's go there. We might swing back around to it as well, but let's go there and take a look at, I think it's slide 4 for this one. Should we pull that one up?
I believe it's slide 3.
Actually, pull up slide 3.
This is a new setup for us. I don't have my slides with me. So bear with me, everyone.
We got them all.
No, absolutely. This is this is the kind of the 4 portfolios we offer. This is the culmination of a long time, many years of work of launching various ETFs to have this kind of full toolbox where we could create these fully diversified solutions that we manage for clients. We rebalance them. We ensure that there's appropriate risk management. We make sure that we're getting exposure to various geographies, various asset classes, various sectors, market caps, and more specifically, investment styles or factors. So you can actually see here kind of the various breakdowns we have, ranging from 60% fixed income all the way to 100% equity on the right. And these kind of now are somewhat of our flagship ETFs. They represented about half of our net inflows last year, here at Fidelity in our entire ETF lineup. Not only have they been extremely popular from a flow standpoint, but they've also been offering us some, really strong performance. So we're really happy with them. And we actually added 2 new mandates to the products a couple weeks back. Yeah, so, we're always trying to find ways to, we want to make these the best portfolios in the industry. And the way that we can do that is to continually review what we have in the portfolio from an underlying holding standpoint. And, we thought that there was an opportunity to increase the diversification on the fixed income side. So if you looked at, like, say, our balanced FBAL, so our balanced all-in-one ETF, we had 40% of our bonds were in 2 mandates that are, extremely well diversified, but still 2 mandates. And we were lacking a little bit on the US bond side. So we had 1 global mandate, which represented 25% of our bonds, and then 75% of our bonds were in a Canadian, aggregate bond type mandate, systematic Canadian bond ETF. So by adding these 2 new mandates, which are US focused, we're once again trying to enhance the diversification of the portfolio. 2 strategies that are fairly different from one another, but both are going to be very complementary to the rest of the stuff we do in the portfolio.
So one of them, as you mentioned, is taking advantage of the high yield story, which has been extraordinary over the last several months, or certainly through the sort of fall season of last year. Just talk about distribution. So these are income for those that want some income. Ultimately, that comes back to everyone in which ways? This is the same way. If they want an income fund, they'll get those distributions. How does it all kind of, the plumbing work ultimately?
I mean, it's interest income, like any fixed income security would be. So I mean, it's not dividends. It's not. I mean, you will have some capital gains. Obviously, that's something as you're trading securities, you will have some, whether it's bonds, equities. But for the most part, those portfolios will be offering some interest. And it's not the design of these portfolios. Like, we're not trying to earn as much income as possible. I mean, we have a bunch of great solutions at Fidelity to do that. Here, we're really looking at total return, right? So we want to make sure that we're ideally outperforming our main competitors in the space, which are passively managed for the most part in terms of like the underlying building blocks that they use. And both of these solutions are either, they're both quant driven, but they are fairly active in the sense that we're doing security selection, we're doing sector allocation in both of these to try to get the best overall total return. Like, we're not necessarily specifically trying to target income. Maybe that's maybe kind of not true for the absolute income that we added in there, where we're trying to achieve the highest possible yield while managing volatility through the use of derivatives and other other tools in our toolbox.
Yeah, it's really interesting. I think you've mentioned before that some of the flows, or money that comes in for the all-in-ones is bought for sort of a risk-adjusted return way of being. That is the attraction. Is that? I'm sure that's still the case, but tell us a bit about that.
Yeah, absolutely. I mean, it's great to have strong returns, but you have to manage risk as well, and that's the idea of having all these different components in the portfolio. And we're just talking about fixed income, but if you look on the equity side, like, there's a reason why last year some of the things that drove performance were the complete opposite of what drove performance, say, 2 years ago. So having exposure, various equity exposures is all, once again, in the objective to manage risk and to get complementary exposures. So, for example, last year, our momentum ETFs were great drivers of absolute and relative return to our benchmark. So those strategies did exceptionally well because what worked in 2023 continued to work in 2024. But when you go into a period, say like 2022, that's not necessarily what leads the way or what protects the best of the downside. That's why we have, portfolios like our value ETFs as well as our low volatility ETFs as part of the portfolio. So it's always with an angle that we want something that's core, but we want to add value. That's consistent with Fidelity's, I guess, value proposition that we've had for 70 plus years is we want to outperform the market and want to give you and your investors the opportunity to do that.
Tell us a little bit on the equity side. So what worked in 2023 worked in 2024. That's true. That generally means a nice allocation to US tech and to a few names in particular. Tell us a little bit about how that either is shifting or not. I mean, there's a valuation story out there that's sort of dangling. Take us inside that exposure and whether it continues or whether that was pretty significant to last year.
Yeah. Well, I feel like when we ended 2023, the only thing that was being talked about, and there's in my conversations with, advisors and even, colleagues here at Fidelity, the big story was, okay, where do we go from here with regards to index concentration in the US? Like, is the top 10, is the Mag 7 going to be, is it going to have a multiple compression? Is there going to be a rotation to things that are more cyclical if we see a soft landing? And basically what we saw in 2024 is just not a carbon copy, obviously, clearly, because things were different, but you did see so many similarities between 2023 and 2024. One of the stats that our colleagues on the quant team that we work with a lot, obviously, because of the nature of our mandates shared, is that for the Russell 1000, which is our benchmark for our US equities, 30% of companies outperformed in 2023. 31% outperformed in 2024. So it was still there wasn't that much more breadth in 2024, albeit we did see like little pockets, like certain months, but it corrected right back at the end of the year when you saw the Mag 7 kind of hold on stronger than the rest of the markets through December. So you look at both years, both are so similar. And, for us, we're trying to, we own some of those names in the portfolio. And actually, maybe while we're talking about this, it'd probably be a good idea to show slide 2, which kind of highlights our US equity component of the all-in-one ETF portfolios. But then it's also available, like if you're looking for a US equity solution and you want to buy just that as a standalone, is available in our All-American Equity ETF, FCAM. But that's the same allocation we have in our all-in-ones for the US equity component, right? So, just to give an idea, we hold about 17.7% of Mag 7, indexes at around 32%. So, we're not necessarily half, but we're close to half. And last year, this portfolio actually managed to outperform the S&P 500, albeit there was still this strength from this large or mega cap US tech names. So the ways that we go about generating our returns aren't necessarily the exact same as what we see for the benchmark, which is more and more heavy to the top, right? So we own less of those names, but we're still able to find ways to outperform. And, just some examples of that, we had for the most part, overweight to the utilities sector, which, yes, did benefit from some of the momentum that was, AI is going to require a bunch more power. So we had some of those names in the portfolio. Those did really well. We also did great security selection in some sectors like consumer discretionary. We did have a lot of exposure to Delta, United. Those are some of the names in our momentum ETFs, particularly, that did really well. So there's different ways to go about doing this. And I think the long-term picture is, we should own these names. They're great companies, but do we need to own 32%? Not necessarily. So this is a great option if somebody's looking for a standalone fund, but then know that in our all-in-ones, that's kind of the approach we're taking.
It's so interesting because it's a little bit of a story of being underweight tech, but still outperforming. And that, I think, is almost anathema to the way a lot of people have thought equity markets have moved over the last, certainly probably the last 2 years, but certainly last year. Tell us a bit about outperformance that doesn't include tech within equities or US tech, large tech.
Oh, it's not easy.
No, but I mean, you've accomplished it. So what's going on?
Yeah, I mean, the examples I gave there were interesting. Like for our momentum ETF, like you would think that we were overweight those names. Our US momentum ETF was actually underweight on average throughout the year to the Magnificent Seven.
I mean, that's
like I said,
astonishing, honestly. Like I don't think anyone would have thought that.
It's got to do with, shrewd sector allocation. It's got to do also with, diligent stock selection, and both those components have to work in tandem to have that success. It's not to say that it will be a winning recipe once again this year, but there's various ways to go about it. And we can see that with our active managers also. Like one of the mandates we have in our all-in-one ETFs is our global small cap opportunities fund. And that did extremely well. By those managers have found great, bottom up stories that they've included in the portfolios, and they generated some really good returns. So I think there's many ways to go about it, but it's you have to be diligent in doing that. And who knows what this year holds. It's we're hearing a lot about looking at tools to reduce that valuation / concentration risk. So we heard of things like equal weights, value focused ETFs. Obviously like the All American Equity ETF we have is more of a core solution, but you can get even more specific and niche if you want to diversify that. But so far they haven't shown that much signs of slowing down in 2025.
Yeah. Well, it is really interesting. Like I do wonder what kind of questions you're getting, maybe even with just the equity all-in-one side of things or others, of how much there is this concentration discussion of, and maybe, as you say, looking at sort of the small cap, active small cap side of things, just things rotating. We don't really have a sense of leadership at this point in sort of traditional sectors yet, but you're sort of moving things around to make sure you're closer to other things.
Yeah, and it's all about trying to figuring out, what are the risks. What risks do you see? What is going to potentially cause markets to have a drawdown? Like 2022 wasn't because we were going into a recession. We saw inflation rise, we saw rates go up, so you had multiples compressed. So the risk was valuations. You go back to a typical recessionary cycle, what tends to lead to the downside is exactly what worked in 2022. So cyclicals like energy, financials, because there's just overall less economic growth, there's less demand for a lot of commodities, there's less demand for industrial companies that are then using those things to build stuff. Like it really depends on on what your outlook is. And from our perspective is that there's not necessarily that big of a risk to go into an actual recession, definitely in the US. Maybe Canada's a bit of a different story, but so it won't necessarily mean that a lot of these cyclical names would hurt, but having some, defensiveness on the valuation side might not be a bad idea to reduce risks of, we saw when DeepSeek came out and said, we have this new great AI tool. You saw a lot of the AI names just get, a little haircut on their valuation multiples in the US. So that might be a risk, so depending on where you see it.
Those are the type of things you might want to be somewhat ready for, ultimately. Let's go into the factors a little bit. So within the all-in-ones, I mean, you're exposed to all of them. So that's sort of a call on all of them on some level. But take us inside sort of what either has the most risk ahead. Some will say that momentum sort of stands to potentially get hit. But tell us about the factors and how they line up for you.
Absolutely. One look through, I guess, that we always kind of consider is, okay, various factors do well in various business cycles. Where are we now? We don't have a crystal ball. We're trying to figure that out. One of the huge advantages that our team has, we have access to great resources, such as Bobby Barnes's team on the Quantitative Index Solutions group in the US. They produce one of the coolest models, I think. We don't have a slide for it, unfortunately, for the group here. Maybe we can work on getting that the next time we're here. But they call it their deja vu model, and it's basically looking at.
That's great.
It's really cool stuff. So they're looking at 15 different macro metrics. So you can include, oil prices, gold prices, inflation, unemployment, services, and manufacturing PMIs. Those are just some of the examples that are incorporated in that. They combine them together and they say which end of month or end of quarter looks the most like this over the past 35 years, right? And they compare it to like the last end of month that we just had, for example. And basically they take the 10 periods that look the most like today and then 10 periods that look the least like where we are today. And in the 10 periods that look the most like if we take the end of December 2024, 8 of those were late cycle periods, 2 were mid cycle periods. So just from that alone, it gives us information that, with fair amount of confidence that we are in this kind of prolonged late cycle type environment. And then, but when you look, and then in their model, what they do is they also look a year forward. And then 4 of those, you go into a recession. 2 of them, you actually go into a soft landing, right? So really, the next 12 months is going to be, it's kind of tough to say where we're going to find ourselves. But right now, the one consistent theme that came out of that is in those 10 periods that look the most like the end of last year, all 10 of them, the quality factor outperformed, its market cap based index. So that's an area we like. If you look at, other factors like momentum was also fairly good. And I know it's kind of counterintuitive to what we're saying with regards to, the stuff that's been doing well is generally trading at a premium, but premiums can persist. And quality names are actually trading at a premium. They generally do over time. So it's not to say that one market dynamic impacts kind of that cyclical story. So those are 2 factors that we like from that perspective.
Okay, that's
but like I said, incorporating value to diversify is not necessarily a bad idea either.
Can you please speak to the outperformance of value factors at international ETFs since the start of the year? Are we seeing a change in leadership? So kind of weaving together some things you just talked about.
I can start maybe with the value question. Like I think last year was quite a surprise that value held up that well. It wasn't really a value market per se. I think for us, anyways, in our products, it was very good stock selection in some sectors, notably utilities, like I mentioned. Owning companies like Vistra Corp were great contributors. Owning some of the good industrial names that helped us, but it wasn't a typical like value cycle where you saw like energy was one of the worst sectors in terms of earnings revisions and performance. That's a value sector right now. So it's kind of come and go. It's going to depend on the stock selection process, and for an active value manager, it might be different than what we've done in our kind of quantitatively driven value index ETF. So value was a surprise, let's say, in terms of performance. I think it was most of the part in line with their broad benchmark indices, which in that environment is better than expected, which would expect some type of underperformance. As for international, we've long talked about in a rotation to developed ex-US. A good start to the year for international markets. I can't say that I have too big of an opinion there. One thing that's interesting though is actually like valuations have gone up in international markets where they're still trading at a discount to the US. Don't get me wrong, but they're not trading at 16 times earning anymore. They're closer to 20. So at one point you have to have earnings growth follow to have a more more in line to the average valuation. So yeah, I don't have
a huge
that strong opinion to be quite honest.
No, that's fine. It's a good.
We own some for diversification. Well, yeah.
It's a question. You don't have to have a huge opinion on it, but in any case, other questions. So this question comes up a lot with Yuri and Timur talking about the 60-40. What's in it? What's in the 40 largely, and is that changing? So does Fidelity plan to diversify the 60-40 all-in-one ETFs with alts? Well, you kind of have a mix of those in there, don't you? But it depends on whether you've chosen conservative or balanced. But in any case, what's the alt mix, if at all?
Yeah, that's a great question. We don't really have any standalone alternative strategies in the all-in-ones right now. That's not to say that, we can't potentially looking at adding some in the future. Alts, I think, are a fascinating landscape. We're seeing, outstanding growth in the industry on that space. I think there's a lot of great mandates and great strategies that allow you to reduce risk potentially, or, attain certain outcomes that are not, necessarily achievable with just, long only traditional investing. So yeah, it's a great place to be looking for innovation. I think right now we're seeing a lot of innovation in that space. So something to be confirmed, if we're going to incorporate in the all-in-ones. But for now, no allocations. But we do have a bit of cryptocurrency, so we can consider that somewhat of an alternative asset class. So for our all-in-one balanced ETF, we're talking around 60% equity, or let's call it 59% equities, 39% bonds, and then 2% crypto. So that's the way that we're approaching it for now. That's something that we saw as a great way to add diversification of the portfolio, and then adjust our risk profile to be something neutral with regards to our main competitors, which are market cap based index solutions.
So I just want to quickly go to the competitive, taking a look at your competitive peers beaten. We don't have a lot of time, but I wonder if you can just run through this. We'll put this slide up. This is the final slide. Just to spend a minute on this, if you wouldn't mind.
Oh yeah, it's a great slide to finish on.
That is.
It's my favorite slide. Yeah. So we've done an exceptional job, I think, of differentiating ourselves from our competitors. We're fairly unique in the sense that we don't have any passive other than Bitcoin. We have factor-based strategies on the equity side, but active fixed income, active small caps. And what it's led to is significant outperformance. So far, we're very happy with the way that these portfolios have performed. We're not trying to take on excess risk. We're trying to do good stock selection, good asset allocation, and we're going to do that consistently. Like, we're not making any big tactical calls. These are strategically managed. You can expect diversification, and you can expect to have some solid performance going forward.
And I think you won a Lipper even. Congrats.
Yeah, great. Now the best neutral balanced ETF. And actually, one other thing that we can mention, it's not so much with regards to the all-in-ones, but just we won the best ETF group over 3 years. So the best ETF lineup in the industry over 3 years. And, we're extremely proud of that, because we are kind of that standout, if you will, in the Canadian ETF industry, where we don't have, market cap index type strategies. So, we've been doing some good work. We're happy to be recognized, and we want to thank everyone who's helped us along the way.
Absolutely. It's great to catch up with you and hear some of the things that have been going on behind the scenes to make all of these great things happen. Congrats, and thanks for joining us, Etienne.
Thanks for having me.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.